Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 10th of March. Let's dive into the week's stock market news. European markets dip amid US trade uncertainty, ECB rate cut, and inflation concerns. European stock markets experienced a slight downturn last week, with the Pan-European Stocks Europe 600 index declining by 0.69%, ending a remarkable 10-week streak of gains. Investor confidence was dampened by lingering uncertainty surrounding future U.S. trade policy. However, potential increases in defense and infrastructure spending by Germany and the European Union helped to limit the overall losses. Performance among major European indexes was mixed. Germany's DAX showed strength, rising 2.03%, and France's CAC 40 index managed a small gain of 0.11%. Conversely, Italy's FTSE MIB saw a minor decrease of 0.16%, while the UK's FTSE 100 index experienced a more substantial drop of 1.47%. The European Central Bank (ECB) proceeded with an anticipated interest rate cut, lowering its key deposit rate by 0.25 percentage point to 2.5%. ECB President Christine Lagarde indicated that rates were now meaningfully less restrictive. Lagarde also acknowledged significant global uncertainties, even describing them as phenomenal by some accounts, referencing potential trade conflicts with the US and other risks. These uncertainties are already appearing to impact investment and exports, leading the ECB to revise its 2025 Eurozone economic growth forecast downward to 0.9%. The central bank also increased its inflation projection for 2025 to 2.3%, up from the 2.1% previously anticipated. Recent data showed a slight deceleration in Eurozone annual inflation, dropping to 2.4% in January from 2.5% in December. The core inflation rate, which excludes volatile energy and non-alcoholic beverage prices, also decreased slightly to 2.6% from 2.7%. Germany and the broader European Union are contemplating significant increases in defense spending. In Germany, ongoing negotiations between Friedrich Merz's Conservative Alliance and the Social Democratic Party to form the next government have yielded an agreement to establish a substantial €500 billion off-balance sheet infrastructure fund. Additionally, they plan to exempt defense spending exceeding 1% of GDP from constitutional borrowing limits and relax debt rules for individual states. These proposals are slated for parliamentary consideration in the coming week. The announcement of this accord triggered a sharp increase in the yield on Germany's 10-year bond, marking its largest daily rise since the period immediately following the fall of the Berlin Wall in 1990. Furthermore, European Union leaders have expressed support for jointly borrowing €150 billion to bolster military spending, driven by concerns about the reliability of future US military aid. In the UK, the Bank of England (BoE) reported a surge in net mortgage lending, which rose to £4.207 billion in January from £3.343 billion in December. This represents the highest level since September 2022. The increase is attributed to a rush by first-time home buyers to capitalize on a temporary reduction in stamp duty, a tax on property purchases, which is set to expire at the end of March. Now our insight into alternative markets, secondaries surge, record capital inflows and a changing landscape. The secondary market in private equity continues its impressive growth trajectory, with 2024 setting a new record for capital raised. Secondary funds amassed a staggering $102 billion, eclipsing the previous high of $95 billion established in 2020. This surge in capital inflows can be partially attributed to the cyclical fundraising patterns of established secondary market managers, many of whom raised significant funds in 2020 and are now returning to the market. However, the secondary market is also experiencing a wave of new entrants, as more fund managers recognize the significant opportunities present in this evolving space. Remarkably, secondaries were the only private market strategy to see an increase in capital raised year over year in 2024. While the landscape is still dominated by established players, evidenced by the closing of funds with Roman numerals, and the market saw the emergence of first-time secondary funds from established firms like Accel KKR and TPG. A significant portion of this new activity is concentrated in GP-led secondaries, specifically the purchase of interests in continuation vehicles. CVs. CVs are funds set up by general partners to hold assets from an older fund that is nearing the end of its life, offering liquidity to existing limited partners while allowing the GP to retain control of promising assets. This trend of asset managers entering the secondary arena to acquire CV stakes has raised some eyebrows among LPs. The core question is this: if these CV transactions represent such attractive investment opportunities, are the exiting limited partners potentially receiving less than fair value for their assets? The answer may very well be yes. Although many CV transactions occur at or near the fund's current net asset value, NAV, the accuracy of that NAV is often subject to debate. Buyers of these CV stakes appear to be operating under the assumption that substantial value will be realized upon the eventual exit, sale, of the underlying assets within the CV. This implies that the valuations at which CV transactions are priced do not fully reflect the potential upside that the original limited partners could realize if they were able to remain invested. However, many limited partners are constrained by governance limitations or simply lack the resources to manage positions in these continuation vehicles, effectively forcing them to sell. The intriguing paradox is that the very limited partners who might be disadvantaged in the primary fund context are now actively committing capital to funds that specifically target these CV opportunities. This seemingly contradictory behavior suggests a pragmatic approach best summarized as: if you can't beat M, join M. Limited partners recognize the potential upside in the secondary market, and even if they are exiting certain investments at potentially less than optimal prices, they are seeking to participate in the broader gains offered by this burgeoning asset class. This dynamic highlights the increasing sophistication and strategic flexibility of limited partners in navigating the complexities of the private equity landscape.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.